Shares of DraftKings jumping more than 4% today after Oppenheimer raised its price target on the sports betting company from $65 to $80 a share. DraftKings set to report earnings next Friday. Let's get to Jed Kelly, senior analyst at Oppenheimer, the analyst who made the call. Jed, great to have you with us.
Thanks for having me.
You expect them to raise their guidance. What's going to be the primary driver of this?
So the primary driver is we analyzed the state data. So on Thursday, you had 4 key states: Illinois, Michigan, Pennsylvania, New Jersey, all dropped the revenue data. And what we saw was DraftKings maintained solid share in online sports betting. However, they've also been able to gain share in iGaming, which we think is being underappreciated by investors. Therefore, we kind of analyzed the January trends. It looks pretty good for a solid 1Q. If they're able to maintain their share, you see your normal seasonality that you have typically with sports betting. It does look like revenue should be, above the high end of their 21 guidance they previously gave of $850 million.
Jed, what's the end game for these online gaming stocks? Is it just a matter of waiting until it's legal in all different states? Is it doing the payment providers? Shameless plug, I'm in BFT, which is PaySafe. But is it PayPal, PaySafe? Or is it just critical mass for these guys? Is it enough that they were there, first, or name recognition is against the pen gaming or things like that?
Well, I think you got to think with DraftKings. One, this is a company that's got phenomenal customer acquisition competencies, them and FanDuel from like the DFS sites back in 2015. So yes, you are trying to gain critical mass, because if you're able to gain critical mass, unlike casinos that were typically regionalized, this is the first time you've had a chance to use your brand, scale your brand, and build a platform nationally. So as you're able to build your brand nationally, you gain more critical mass. Therefore, you're able to reduce your customer acquisition costs and get massive scale and potentially generate leverage eventually on your sales and marketing.
Hey, Jed, it's Jeff Mills. Thanks for being on. I just had a question about the total market size. I've seen estimates of $40 to $50 billion annually, and then thinking about what a reasonable market share might be for a company like DraftKings, and then triangulating all of that with the valuation. I'd be interested to hear what you think.
So right now, the way we kind of look at it, we have about sports betting, online sports betting, about $11 billion by 2025. That assumes about 70% of the population is legal. And then for iGaming, we're about $5 to $6 billion, assumes 30% of the population is legal. However, you are seeing that if you look at New Jersey, the amount of tax revenue these sites are bringing in for the state, we think that you could have more of the population with legalized sports betting. The other thing to consider too is we're just in the early innings of this sports betting cycle, and as live betting becomes more important, these platforms are going to be able to give you more products. You're also going to have younger people, in college, grow up more on the legalized channel. So the market could be huge. I mean, you've seen estimates, in 10 years, if you have 100% of the population, sports betting could be $30 billion in revenue.
Jed, thanks for being on. And you've had the call on this one for almost, 9 months or so. So great call on this. I'm just wondering, your target, how do you get there? What do you think is the most likely thing that could go wrong to make things not as rosy as they have been for quite a while?
Yeah, I mean, the target is it's a combination of a DCF out to 2030, which assumes, DraftKings has 30% share, and then, then a high revenue multiple comp with other disruptive internet companies, like a Peloton, a Fiverr. What could go wrong? It's regulation. I mean, that's what could. I mean, I think if you look at New York State, right, Governor Cuomo was, attempting to do a single provider model, which I think would be bad for the industry, right? It would disrupt innovation. So it's unfavorable regulation is really what can get in the way.
Jed, great to have you with us. Thanks for your time. We appreciate it.
Thanks for having me.
All right, let's trade DraftKings. Steve Grasso, you're up.
Yeah, I don't know really how to play this. I think to Karen's point, the biggest thing for them is that the worst is potentially behind them and only more states are opening up. So I think specifically DraftKings is a buy. I'm in BFT because that's the one that offers payment solutions to DraftKings, as well as a host of other companies.
Shepard Smith here. Thanks for watching CNBC on YouTube.